The idea of a 50% prior bar retrace was a bit sensational for some as we led into the Roaring Kitty live stream on Friday. Many strategies in stock trading have to be understood in order to seriously consider such strong moves despite all other reasons. I have taken a statistical approach again and have found some interesting answers. Welcome back to the channel on this Saturday. This is ARCa and let's pop in the GameStop. Let's kill 'em, team. What is up, you guys, and welcome back to the channel. Please do me a favor and hit that like button, subscribe to the channel, do everything necessary to get this thing to live long, thrive, and survive. So let's go ahead and dive in here to GME on the monthly chart where I do have some interesting news for you. Okay, you guys, so I am going to go ahead and go over something else, right? My buddy Anthony inside of Twitter X actually notified all of us that the expiry for Roaring Kitty's 120,000 options contracts expiring on June 21st is actually expiring at the quad witching as well. So it is confluent to the same date, and that is actually a very curious thing, right? Because that is going to be the major expiries for stock index futures, stock index options, stock options, and single stock futures, right? That is going to be that phenomenon that occurs in the financial markets where all of those four assets expire all at once, right? So very interesting for that to be happening, right? We have also ran a back test in statistics for that very occurrence, right? So here you go. So let's just go ahead and start first with the physics and statistics, right? Then we'll go ahead and do the options, expiries, and statistics. So in this case, we have back tested on the monthly time frame, historical volatility and linear versus stochastic momentum that you can see right over here, right? And this is actually a very curious occurrence as it has led to, I understand there's not that many iterations here, right? It's actually 5 iterations, right? And it's the criteria is anytime that volatility, let me just make this a little larger for you, right? Anytime that volatility starts to cascade below or fall below the 90th percentile of critical expansion paired with an upside in stochastic momentum, we've actually back tested this and have come across some very interesting results, right? So let me just go ahead and kind of pop that data here for you, right? So let's go ahead and take a look at this. So this is what you're observing here. 5 out of 5 iterations marking off a 100% upside accuracy, and this is actually shooting the asset up 37.34%. And I will say that, remember, it's just 5 out of 5 iterations that are proving correct. At some point, this is going to be proven incorrect, but so far it's far beyond correct. And working on the 6th iteration correct upside iteration now, but presently, right, since the firing of the signal actually happened here on February 1st, 2022, and the signal still has not invalidated since we broke below that 90%. The invalidation will be anytime that volatility reaches back into the critical expansion zone or the opposition critical contraction. So you can see here we have never done that during this entire time, and that proves that the signal is still currently fired for a continuation to the upside, right? So let's go ahead and take a look at this. You're going to be wondering here, well, if it's an upside move, then why does it have a downside? This is why statistics come into play. We are able to measure its standard deviation as well, right? So yes, 100% accuracy. We have an average upside thrust of about 37.34% with a standard deviation of 95.59%, right? So what that's telling us is that with this 95.59%, we can go ahead and evaluate from the opening of the signal a minus 95% drop, right, which could be located all the way down here, right? That would be your 95% drop right here at around $1.29. But it looks like that drop has kind of subsided, right? That was the average drop on that. So it looks like 64.48% was the absolute low before us making that pop to the upside based on the firing of this signal, right? Now, okay, let's go ahead and take a look at the upside measure now. So it says here that we have a 37.34 upside bound based on the firing position, right? Which was 28.15. So let's go ahead and mark off the 34%. 34% right here was leading up to $37.94, around $38, right? So very curious for us to have those $38 marks because, yes, I do recall having a $40 resistance over the last few weeks or a couple of weeks. Now, I have also calculated beyond this target because you can see here that we have continued, right, all the way up to intraday, that is, right? Intraday, we've already continued all the way to the $64 mark, which, by the way, check this out. Calculating the upper bound of the first standard deviation, right? When you're speaking statistics, the negative values are not used; they're unusable, they're non-viable, right? So the upper bound of the first standard deviation is measuring an upper bound of 132.93. Now, if we measure this iteration here, right, from the opening of the signal of $28, and we measure upside to that $64 valuation right here, we're looking at about 129.32% move to the upside, marking it off almost 100% to its accuracy, right? Very, very impressive. Now, what's going down here? Are we able to kind of measure maybe a continuation to the upside, right? Well, I will say this. Now, check it out. The standard deviation based on the upside on this, right, was a decline of minus 58.25%. Check out what that decline was. Right? From that $64 valuation is a minus 56.74%. Very, very interesting, right? But let's just kind of leave it like that, right? I'm just saying that we can't really use them, right? But I'm kind of showing you how maybe we could, right? Whatever. Now, the upper bound of the second standard deviation is giving us a very curious read there too. So here it is, right? Let's go ahead and measure that. The second standard deviation upper bound, 228.52% upside thrust is going to put us right about here, 228. So let's go ahead and put that in just a moment. There we go. That would take us to a target of about $92.51. Now, if we were to measure the upper bound of the third standard deviation from those results, let's go ahead and kind of pair those in there too. Okay, so here we go. You're looking at about, that's what, 324.11. We're going to need a little bit more space here, unless we can make it. 324.11. Okay, so that would put us to a target of where? My goodness, I couldn't even explain to you just how accurate this upside would be based on statistics signaling that it would be $120.45 when we had an upper bound here, which was the prior $500 target that we hit in February 2021 of $120.75. Mathematics rules your team. People lie, numbers don't. Okay, so this is what the statistics are proving. This is what the iterations of historical volatility and linear versus stochastic momentum are doing based on the firing of a critical signal where volatility drops beyond or below the 90 percentile of critical expansion, right? So that is currently what I'm observing here for the statistical run on this, right? So just kind of be patient out there, and let's see if the statistics run wild, right? But please remember, all the statistics are not they're not certainties, right? They are probabilities, and at some point this is gonna. I know, I get it, right? At some point this is not gonna be 100%, but until then we have to make sure to kind of keep that under deep consideration, right? So let's go ahead and now move on towards the what I was going to show you, right? The quad witching, right? So please remember that the quadruple witching refers to a phenomenon in the financial markets where 4 different types of derivative contracts expire simultaneously, right? This occurs on the third Friday of March, June, September, and December. The 4 types of contracts that expire are, like we spoke before, are the stock index futures, right? This is the agreements to buy, sell stock index at a set price on a future date, right? Stock index options. Contracts giving the holder the right, but not an obligation, right, to buy or sell a stock index at a predetermined price before a specific date. Now, stock options, contracts giving the holder the right, but not the obligation to buy or sell a specific stock at a predetermined price before a specific date. It's going to kind of be similar, right? And now the single stock futures, the agreements to buy or sell a specific stock at a set price on a future date. Okay, so I guess the impact on a market on that would be the quadruple witching days are known for increased volatility. And that's why I measure volatility a lot, right? And the trading volume also tends to increase on those time frames as well. As traders, investors, they adjust their positions before the expirations on these contracts. You know, you're going to get institutional traders, individual whales, right? All these kind of pros, they're going to be readjusting their portfolios on that, right? But yeah, now let's go ahead and just switch over that window and come on over to this side here. And this is currently the data that I took here, right? So this is 10 days pre-event, the event on the day return, and post-event return. So I did 10 days of pre-date returns. I did 10 days of post returns, and then on the date, marking off the 21 days till June 21st, right? So this is all the data here. I was expecting to get some bigger returns on this, but unfortunately the mean actually came down to a 1.77% return on average. There's going to be the 10 days prior. Now on the event, it looks like there is a 0.46% return, and there is an average post-event return of 1.74%. So yeah, in total, right? In total, we have just like 3.5% in there, 3.62%, whatever that is. It's okay, right? It's just we had to look. I had to look to see if we had any data that would prove this otherwise. And I did measure this starting from the 2010 quad witching all the way to the present. Right, so this is the data here, and this is specific to GME. Right, it is not specific to index returns, or is not specific to you investing into like Apple or anything else. It's specific to GME. So while the data here is not so attractive, I still I will still say that it is very good that we took into consideration that. Okay. However, the case, it's still positive, right? And now that the financial markets are starting to make new highs, I'm wondering here if there's going to be an inversion because of the downside that we just experienced on GME recently. What about that decoupling, right? There was a decline into GME's downside. Remember that also had to do with the 4-day closure, and that's where ARCa Bulls came up and said that we may see a 50% prior bar retrace down to the targets of around $38, right? Now, there is also, I guess the bad news would be is that we now have a weekly closure and we also have a 5-day closure, right? So let's go ahead and take a look at the weekly candle. And, okay, so yeah, this is the weekly candle closure. So what's good here is that the weekly closure is now on a downtrend. So usually there is a 50% retrace, right? So 50% retrace on a weekly would actually be back to around, I would say, the upside, right? So let's just go ahead and kind of observe that. So it looks like the 50% retrace to the upside, since we were coming down, would be roughly around 34.86. So let's just go ahead and mark it off right there, as price action may actually lead towards that upside, which is now making me believe that there will be an upside, since there was a complete decoupling from SPY, right? As you can see, the SPY created an all-time high on Friday. Very curious, as we were noticing that GME, AMC, and the SPY were correlated to each other pretty nicely until immediately not, right? It just wasn't, out of nowhere. So, yeah, I guess it would be pretty fair to assume that if the broader markets start to pull back coming into the week open on Monday, then there could also be an inversion into GME's upside, of where I'm seeing a resistance level coming up right up to that zone of 34.86. Let me bring it to you, right? There we go, 34.86. Okay, you guys. So I just want you to be careful in the broader markets. I understand that things can be a little tough out there, right? We just have to be careful with what we do. And yes, sorry, if you were trying to find out why I had all these lines here, this was part of the analysis here for the back test on the all this information back here. So yeah, we're going above and beyond. Make sure to join the ARCa Bulls trading team. I'm sure that you can see those links right there, right? Make sure to hit those links to join and come on by. And also remember, team, that I'm still offering a very limited amount of seats now, as it's absolutely reaching its capacity for the beginner's course, right? So please reach out to me at ArcMastersCourse at Gmail to take advantage of the 5-week beginners charting and trading mentorship program, right? So ArcMastersCourse at Gmail is where you want to reach to get yourself a reserved seat, right? So please make sure to act on that immediately before it's completely taken, as I'm approaching max capacity right now, and we're looking pretty good. All right, team. Well, thank you so much for watching, and I will speak to you soon. Please take whatever I do show and iterate within these videos as just a form of entertainment, as I cannot suggest for you to buy, sell, or hold any assets whatsoever. Never, ever, 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 ever. I need you to do your own due diligence, and everything will be cool. But with that said, team, I wish you well, a very, very good rest of your night and or day, and I'll catch you at the bell on Monday. Adios, team. Oh, yeah.